Welcome to our annual State of the Markets presentation. We're delighted to have all of you here today and look forward to sharing some important information with you. I'd like to draw your attention to these disclosures. Please take a few moments to review them and let me know if you have any questions. As usual, we're required to show these, so I'm here today to help you gain a better understanding of what happened in the markets in 2020 and what may unfold in 2021. If you have any questions throughout the presentation, please feel free to ask. I believe there's a chat button that you can go to pose a question. We'll try to get to them as we go through, though we have a lot of material to cover. But don't be afraid to ask, because chances are someone else is wondering the same thing. So if anything comes up, just ask and we'll try to get to it. If not, we'll get to it at the end of this presentation. So yeah, again, it should be a comment button that you can just put your question in, and we'll try to get to them as we go. Today, I'm going to focus on 4 key questions. How did stocks perform in 2020? What drove that market performance in 2020? Where are we now? And what do financial professionals forecast for 2021? So let's begin a recap of a most extraordinary year. Today, we're going to take a look at how a volatile and unprecedented 2020 unfolded and what 2021 may hold for investors. No one could have predicted how the pandemic would roil the markets throughout the year. Stocks plunged in March and April for record February highs as global economies seized up following the economic restrictions and lockdowns put in place to control the spread of the coronavirus. Stocks staged a massive rally from March lows as major stock indices repeatedly set new highs throughout the course of the final 2 months of the year. Indicating just how difficult it is to predict the markets, stocks closed the year well above the pre-pandemic expectations of big Wall Street market analysts. As you can see from this chart, we actually closed up 16%, well above that group average that you see there. The coronavirus pandemic was the dominant influence on the stock market performance in 2020. In addition to the unprecedented pain it caused for so many in the US and abroad, it also impacted everything from Federal Reserve monetary policy and government spending to business results and economic performance. In the following images, we'll discuss each factor separately and in more detail. First, though, let's look at how these factors affected stocks over the course of the year. Stocks started building on the previous year's gains, but dramatically reversed in March and April as the coronavirus pandemic began to spread to Western Europe and the United States. It was only after a series of unprecedented monetary and fiscal policy actions that stocks began their long climb back to pre-pandemic levels. Stocks eventually moved past the highs established earlier in the year in the wake of November elections and the announcements of successful phase 3 COVID-19 vaccine trials. Stocks finished strong in the end of the year, buoyed by the approval of 2 COVID-19 vaccines and the passage of another fiscal relief bill. As you'll notice, we've color-coded our 4 market drivers, identifying dates where each of these factors moved the market significantly. The S&P 500 is an unmanaged index that is generally considered representative of the U.S. stock market. Just keep in mind that past performance does not guarantee future results, and actually individuals cannot invest directly in an index. COVID-19 isn't often the global pandemic's drive market reaction, but that certainly was the case. As you can see in February and March, we identified 2 key days that were really the opening act on the coronavirus pandemic that affected so many Americans. Markets were initially slow to react to the danger, but as the implications became more understood, markets staged a broad retreat. In record time, as we see in December, the FDA approved the first vaccine for protecting Americans against this particular dangerous virus. In response to markets that were seizing up, the Fed stepped in with an unprecedented series of actions, including cutting interest rates to zero. The federal government followed with its own unprecedented actions by bipartisanly agreeing on a massive $2 trillion spending plan known as the CARES Act to provide individuals and American business with immediate relief. These actions ended up setting the groundwork for the eventual recovery that is illustrated by this graph. With a spreading virus and widening economic lockdowns, the economy shrank, with the worst of it occurring in the second quarter of the year. The economy rebounded thanks to the fiscal and monetary steps we just discussed, as well as due to the summer months that typically resulted in a slowing viral spread. While most investors gave a pass to companies about reaching pre-pandemic earnings targets, investors were often finding themselves surprised by the strength of the earnings, given the economic landscape. This was especially evident following the close of the second quarter. Earnings have since continued to rebound, but for many industry sectors, there remains some ground to make up. The Federal Reserve was already on a path of lower rates in response to a slowing economy, implementing 3 rate cuts in the second half of 2019. As the coronavirus pandemic's economic impact became more apparent in March 2020, and amid a slumping stock market and a tightening debt market, the Fed implemented unprecedented reductions in the federal funds rate. The Fed's policy response to this unprecedented economic challenge wasn't limited to cutting the federal funds rate, though. As we'll see in the next image, the Fed pulled several levers to address the immediate dangers facing the economy and capital markets. These are just some of the steps the Federal Reserve took to combat the disruptions resulting from the multiple disruptions COVID-19 caused. Many of these items are esoteric, but don't worry. There will not be a test at the end of this image. However, it's important to see the range and scope of the Fed's actions in just a few short months. Stemming from the lessons learned in the 2008 credit crisis, the Fed's actions were much quicker and more decisive in addressing strains in the capital markets. Beginning with a surprise Sunday evening press conference on March 15th, Fed Chair Jerome Powell announced a drastic reduction of the federal funds rate to a range of 0.25% to zero, and committed up to $700 billion in asset purchases to maintain liquidity in the credit market. Initially, the market greeted this move negatively, believing that the Fed saw more trouble than the market had factored into stock prices up to that point. As the timeline illustrates, the Fed continued to implement new measures to steady the financial markets. While the Fed implemented more programs than we have outlined, let's take a look at some of the key policy initiatives put in place during the worst of the market slide, including the following. The creation of a commercial paper funding facility to buy short-term unsecured debt was crucial to ongoing business funding. The creation of a money supply mutual fund liquidity facility to promote the purchase of assets from money market funds, ensuring value preservation. Funding was provided to support credit to large companies and revive the 2008 Term Asset-Backed Securities Loan Facility, known as TALF, to prop up corporate bonds. With the passage of the Paycheck Protection Program, otherwise known as the PPP loan program, and the extensive distress in small businesses nationwide, the Fed introduced a lending facility to buy PPP loans. This helped to facilitate bank participation by taking non-performing loans off the bank's balance sheets. Sweeping changes were introduced to the Main Street Lending Program to make it possible for a broader range of small and medium-sized businesses to apply for loans. Also, there was a change to the inflation target to a rolling average of 2%. We'll get into this a little bit more, but the two mandates for the Fed are full employment and low inflation. And historically, it's been a hard 2% stop on a quarterly basis. However, they changed that to a rolling quarterly basis to allow the economy to run a little hotter and actually reach its 2% objective. What does it all mean? Remember the previous image that showed the stock market performance in the first half of the year? On May 18th, stocks notched another solid gain when the Federal Reserve restated its commitment to do whatever would be necessary to support the economic recovery. With an economic shutdown amid increasing COVID-19 cases, corporate earnings dropped and future earnings became challenging to project. In fact, many publicly traded companies stopped providing investors and Wall Street analysts with forward guidance. Absent such guidance, and in the face of economic contraction, Wall Street analysts cut 2020 earnings estimates multiple times. It turns out that the economy rebounded faster than expected. In fact, many companies surprised investors with better than expected numbers in the third and fourth quarters. Overall, earnings were still weak, but the fact that they were better than feared lifted investor sentiment. If you look at the overall year-over-year earnings growth rates, you'll see that they fell into negative territory in 2020, although analyst estimates expect they will eventually begin growing again by the first quarter of 2021, especially given the prospect of widespread distribution of COVID-19 vaccine, paving the way for economic growth. The economy suffered a deep contraction in 2020 as the pandemic led to economic lockdowns nationwide. As you can see in GDP growth, the contraction began in the first quarter, primarily from a drop in March and continued through the second quarter. We saw a strong rebound in the third quarter as monetary and fiscal stimulus programs began to take effect and more states began to permit a slow and limited reopening of businesses. As to be expected, the labor market shows American workers suffered from the job losses associated with lockdowns, especially on Main Street and in industries such as travel and hospitality. The employment picture has improved, but progress is fragile, and achieving pre-pandemic employment levels may take a long time. With economic activity slowing, 2020 saw a deceleration in inflation and a decline in consumer confidence. While inflation did pick up from its pandemic trough, prices are expected to decrease at historically low rates we've seen in recent years. Consumer confidence rebounded as economic conditions improved, but could take another dip. A widely available COVID-19 vaccine in the spring may help boost consumer confidence. The manufacturing sector was hit particularly hard as consumer and business spending fell while international trade stalled. Its recovery has been slow, but it's expected to see some positive growth in the fourth quarter. So we've looked at some of the factors affecting market performance in 2020. Now let's examine the headwinds and tailwinds that could affect the direction of economic growth and financial markets in the year ahead. Here we see a group of 20 leading indicators. These indicators help forecast pressures on the economy and financial markets in the next 3 to 6 months. Green is positive for the economy. We may call that a tailwind, help pushing economic growth along. Yellow is caution, and red is a headwind, which acts as a potential brake on economic growth. As you can see, this chart shows where we were in 2010. We see a lot of green on the board. The economy was beginning its sustained recovery from the 2008 credit crisis, and the main risks at the time were volatility levels and the political environment. The only indicators flashing caution were credit availability and housing and mortgages. As we entered 2020, the economy presented a mixed picture. As you can see, there were several green indicators signaling potential economic strength, but also a near equal number of caution indicators, including the leading economic indicators and the yield curve. Plus, there were 2 measures in the danger zone: geopolitical risk and the political environment. As we approach year end, the economic indicators pointed to a mixed picture of the economy. As you can see, only 7 of the 20 indicators are in green, including monetary policy, which remains accommodative, housing, which has been a source of strength, and index of leading economic indicators, which is a modestly positive sign. 4 indicators are signaling red, most notably in current equity valuations. Finally, many indicators, nearly half of them, are indicating caution. Weakness in consumer sentiment and labor market may be the most troubling since our economy is normally driven by a healthy consumer. Let's delve a little deeper in one area of these speedometers, the leading economic index. This measurement includes 10 components ranging from stock prices to manufacturing orders. When examined together, the data may give a clearer, less volatile view of where we are. The latest report shows continuing modest growth, suggesting that economic recovery may continue in 2021. As you can see in this chart, recessions have never started when the LEI is increasing. Of course, the country has never confronted the prospect of another potential wave of COVID-19 infections that could lead to an economic slowdown. A vaccine would surely help mitigate this risk, but it remains uncertain how broadly and quickly distribution can occur. It's important to remind people that past performance does not guarantee future results. But as we review this chart, like the leading economic indicators, history can help us suggest where we are in the economic cycle. We just saw from the leading economic indicators and the economic speedometers that the economic outlook is a bit uncertain. Recovery from the coronavirus-induced recessions remains fragile, especially in light of a resurgence of COVID-19 during the winter season and the economic lockdowns that have followed it. We see several headwinds the market could fight in the year ahead. While the COVID-19 vaccines are a hugely positive development that may help speed economic recovery, there remain outstanding questions about how quickly vaccines can be distributed and the willingness of Americans to actually take them. Hiccups in either distribution or the number of Americans taking the vaccine may unsettle markets. Even as most expect the economy to grow in 2021, the economic scarring of the pandemic remains a big question mark. We do not know how fast Main Street businesses will be able to recover, or how many may be unable to recover at all. Corporate balance sheets for many industries, such as the travel and hospitality sectors, have been damaged in a way that may limit these companies' ability to grow, rehire workers, invest to grow, or generate profits amid reduced revenues. As this economic scarring reveals itself over the course of this year, it could provide an obstacle to the markets. While bond yields may be expected to remain around historical lows, many professionals anticipate that rates may rise above today's levels as economic growth accelerates and demand for credit increasing. Rising yields could weigh on stock valuations, affecting the overall direction of the market. In fact, I would add that we've already seen around a 50 basis point increase in the 10-year Treasury note. So there is already built in, even today as we speak, some inflation expectations and rising yields, just something to keep in mind. In addition, geopolitical events are a perennial wild card in any year, and for the most part are unknowable, obviously. Renewed saber rattling by North Korea, a Russian invasion, or even a Russian meltdown, or a China threatening Taiwan, along with a number of scenarios, could upset markets and send them lower, regardless of other positive factors that may be in play. I think these latter risks are somewhat remote, but obviously those are factors that could come into play. We believe there are a number of tailwinds that could continue to support economic growth in 2021. The rollout at year-end of multiple COVID-19 vaccines bodes well for the economy, since protection against the virus is essential for getting people out of their homes and opening up local businesses. We'll need to keep an eye on the pace of immunizations nationwide and Americans' willingness to receive the vaccination, but early days provide reasons for optimism that this pandemic may be nearing its end. The Fed has stated that it will continue with its policy of low interest rates, even in the face of inflation, that may exceed its target rate of 2%, provided that such an excess inflation is temporary. A looser monetary policy should continue to act to support a recovering economic and securities markets. I will say that the Fed is going to let the economy run hot. It'll let as long as the rolling average doesn't break that 2% barrier, they're going to let it run hot for a while. And I think we're probably going to see low rates for a while. As the economy rebounds, corporate profits have the potential to expand meaningfully. And from an investing point of view, compare very favorably with prior years, especially the prior year pandemic depressed earnings. These favorable year-over-year earnings comparisons may support continued positive investor sentiment. Economic recovery should lead to lower levels of unemployment, providing greater economic stability to the newly reemployed and greater confidence more generally among consumers. A more confident consumer is likely to spend more, a good thing for American businesses. This confidence could also unleash the robust savings that Americans have accumulated during the pandemic, leading to potential higher spending than many might otherwise have expected, and leading to what some are predicting is a replay of the Roaring '20s. While it is expected that a Biden presidency will remain tough on China, many professionals believe that Biden will pursue negotiations more quietly and behind the scenes and in partnership with our allies. It is also anticipated that President Biden will seek to reduce the friction between the U.S. and our trading allies that flared from time to time over the previous years. Many think with reduced tensions, American businesses will feel more confident about making certain business and investment decisions as the level of uncertainty declines. Few professionals expect inflation to rise in any substantial way, at least over the next year. Inflation may pick up thanks to the fiscal and monetary stimulus of 2020 and increased consumer demand, but any increase is viewed as unlikely to move the Fed from its current accommodative policies. Let's examine this chart to see where stock prices are trending against historical averages. The most common way to do this is to look at the PE, or price earnings ratio, which is a measure of what investors are willing to pay for a company's earnings. If you look at the dotted line in the middle, you can see that the PE for the last 25 years is on average around 16.5. You can also see that the PE moves quite a bit, with a peak during the dot-com boom and a trough during the credit crisis. As of September 2020, the PE was at 21.5, which is more than one standard deviation above its 25-year average. It may bear mentioning that big technology stocks, which because of their growth prospects typically sport higher price earnings ratios, represent a greater proportion of the S&P 500 than ever before. So a comparison to the distant past may actually have some limited value. Before we move on to look at 2021 forecasts, it might be helpful to review the expectations around COVID-19 vaccination, since so much of what the market and economy can be expected to do may depend on how effectively and quickly the country can vaccinate its citizens. Let's quickly review a snapshot of those expectations. December 14, 2020, first Americans were receiving the COVID-19 vaccine. By the end of December 2020, the forecast was 20 million Americans will have received a vaccination. However, this figure was closer to 5 million in actuality. By the end of 2021, it was estimated that another 20 to 25 million, it's the end of January 2021. It was estimated that another 20 to 25 million Americans would be vaccinated, or between 40 and 45 million in total. Based on the initial vaccination data, that number now appears too high. By the end of April 2021, President-elect Biden had promised that 100 million Americans would get the vaccine within the first 100 days of his presidency. It is important to note that each state will be responsible for the prioritization of who receives the vaccine and the distribution of it. This has the potential of mixed results in achieving these national objectives, as some states are better equipped or more capable than others in executing such a rollout. We've talked a lot about what impacted markets over 2020 and what may impact markets in 2021. Now let's see what the professionals have to say about where they think the market is headed. Inflation is an important economic indicator. Rising prices impact the entire economy. Too much inflation can hinder growth, while too little inflation can be a sign of economic weakness. Inflation remained low in 2020 as the prices consumer goods and services rose just 1.2% year over year. Food and energy are broken out since they tend to be more volatile from month to month. As you can see, the increase in food prices was substantially higher than overall basket of prices, rising 3.7%. However, the other volatile category, energy, fell sharply. Energy costs declined by 9.4% due to an oversupply of oil and the economic slowdown that reduced consumption. When excluding these more volatile sectors, core consumer price index, the CPI, was higher by 1.6% and well below the 2% mark that the Fed sets for itself. Inflation is also one of the key indicators that the Federal Reserve uses in determining the levels of interest rates. Currently, inflation is below the Fed's target rate of 2%, even on an absolute basis and on a rolling basis. The Fed has said that absent persistent above target inflation, they do not foresee raising short-term inflation rates anytime soon. Also, by the way, which feeds into mortgages. So one thing everybody should be looking at, if possible, is to do a refinance, because rates are definitely in the sub-3 category at present. The economic slowdown we saw in 2020 represented downward pressure on an already tame inflation landscape. While most observers do not see inflation as an imminent concern, some have voiced worry that the excessive fiscal and monetary stimulus may, in the long run, cause inflation to flare. I personally feel like at the present that would actually be a good thing rather than a bad thing. Though obviously, rampant, out of control inflation is not something that we or the markets particularly enjoy. Forecasters are painting a mixed picture of the economy, indicating a deceleration in economic growth from previous forecasts, while expecting unemployment to fall faster than previously thought. Given what happened in 2020, it may be a relief that some expect the nation may see solid economic growth throughout 2021. This surely was taken prior to the announcements of the effective COVID-19 vaccines, so it's difficult to say how much forecasters will alter their outlooks given the broad availability of the vaccine. And I might also add, these numbers generally mirror what has been happening in many parts of the globe, except maybe with the exception of China, who had, well, first of all, had a different reaction to COVID, and both in terms of the lockdown and also in terms of their fiscal spending, primarily in debt-driven investments, but also because the data is much different, and oftentimes it's considered only partially reliable. The unemployment rate spiked in March and April as the economy began to shut down, steadily recovering over the subsequent months. As we saw in an earlier slide, unemployment is expected to fall further as economic activity continues to recover. A healthy employment picture has historically augured well for the economy. It is also worth pointing out that we also saw a substantial rebound in wage growth. While ordinarily viewed as a healthy positive for the economy, the jump in wages is mostly due to the combination of a quicker return of higher paying jobs and the slow return of lower paying service jobs, skewing these numbers. And I also point out today, actually, the unemployment, new unemployment numbers came out, people showing unemployment figures, and that was actually higher than expected. So I think this employment picture is definitely going to be wobbly as we go forward. So what are the professionals forecasting for domestic equities in 2021? On average, they're expecting a healthy increase from 2020 close. None of the highlighted analysts expected a down year, as expectations for increased fiscal spending, continued monetary accommodation, and a vaccinated American public are expected to translate into economic expansion. Of course, no one knows for sure what equities will do in 2020, and predictions at this stage are just that, predictions. However, these analysts' perspectives show that, for the most part, Wall Street remains largely optimistic. We've covered a lot of information today, and so don't be afraid to ask questions or get some clarifications. If there is one takeaway here, is that the path the markets take this year is never a straight one. Even in a good year, it's really important to note this. The S&P 500 can suffer substantial declines, but for the patient long-term investor, stocks have shown themselves to be excellent means for growing wealth and helping them pursue their financial objectives. Let me draw your attention to two specific examples of this. Look at the series of positive annual returns in the 1995 to 2000 period. Even as stocks ended the year higher, each year was marked by meaningful intra-year declines. Also note the bull run following the credit crisis, a bull market that saw multiple years in which intra-year declines were actually in double digits. Of course, the year that just ended is a case study in a market that suffered deep intra-year declines, but ended up providing solid gains for the patient buy and hold investor, even if it didn't seem remotely possible from March's vantage point that stocks would fully recover and then some by year end. So what's the lesson here? Investors may harm themselves when they react to short-term market drops. In our view, the best decision for investors is to pursue their goals based on their time horizon and risk tolerance. So what can you do in 2021 to move closer to your goals? Here are a few action items for you. If your life or personal situation changes, keep us in the loop. We want to hear about important family events like births and deaths and changes in employment. We also care about health issues, employment changes, and any financial developments like an inheritance that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so we can help you pursue the life you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about investing changes. These could be details like a shift in your risk tolerance or any concerns about the market environment. Finally, remember to go over your state documents, beneficiary designations, and other paperwork to make sure it is all up to date. A well-organized estate is one of the best gifts you can give to your family. We're here to walk you through whatever financial questions, worries, or excitements you may have. Our priority is to always help you make informed choices and stay on track. Throughout 2021, we will focus on delivering the following to you. We'll keep you informed through regular communication, as most of you have already been receiving. We'll manage your investments according to your personalized strategy, and we'll stay on top of changes in the market environment and make prudent adjustments where necessary. So we've gone through a lot of information here, and I'm sure many of you still have lingering questions. Remember, if you're wondering something, there's a good chance that someone else in the audience is too. So now let's go to any questions that we have. What do you think inflation would, or why do you think inflation would be a good thing? It's one of the questions coming from the participants. Right now, the issue is, from an economic perspective, is the risk of deflation. These risks have been persistent for a long time, which is why we've seen interest rates decline over the last 30 years. A lot of that has been wage pressures, globalization, mechanization or automation, and things like that in the global economy. So there's been heavy deflationary forces. And so we really haven't seen any kind of excessive inflation for a long time. And the reason why the Fed changed its policy to a rolling quarterly average for its inflation target was because in the past they had a hard stop at 2%, and every time they hit that, they would start raising rates. And every time they did that, they tapped the brakes and the economy went into a tailspin. And that's because growth is pretty anemic globally, especially for developed economies. China maybe being the exception, and even their inflation has been steadily decreasing. So right now, inflation, especially wage-driven inflation, is deemed to be the best possible outcome, mainly because they expect it to spur economic growth. They expect it to the money supply to feed faster through the economy, which is really what drives inflation, and that's generally a good thing. Is it rising tide lifts all boats, and so that's why it's seen as a good thing. Of course, at some point in time, when inflation goes above 2 and goes to 3 or 4 or 5%, that has a negative impact on the economy in the form of rising prices and out of control prices. So that's when you'd expect the Fed to step in. But generally, right now, inflation would be a welcome thing. Are there any other questions? Don't be shy. We have a lot of information that we've covered. From Lawrence County, you showed a chart of a number of forecasts for the S&P 500, generally optimistic. How reliable have such forecasts been in previous years? It's a very good question. And I say that because, we had in the past, not in 2020, but in the past, we've had years where we've expected higher inflation, especially like 2018, where we expected higher market returns, only to have a substantial correction in December of 2018 and miss the mark. Part of that was due to the Fed tapping the brakes, I believe, in that fourth quarter, which caused a slowdown in the economy and earnings forecast, and hence the markets reacted accordingly. So some of these things are hard to predict, and only a few people get it right. But generally speaking, if you want to say, hey, are we expecting positive or are we expecting negative growth in the markets? I mean, I think analysts, generally speaking, and in fact, most years, there's going to be a positive return on the market. So there's a tendency towards that. I think if you look at the overall indicators, the economic indicators, I think the analysts are probably right in that we're going to see growth in the markets, barring any kind of black swan kind of event. And I think there's a foundation for substantial growth. And I do believe if and when we really get past the pandemic, we're going to see markets outperform even the estimates. That's my personal opinion. I think there's a good economic foundation for growth here. But to your question, I think that, they've generally been fairly reliable, just maybe not that exact. Hopefully that's answered the question. The next one is, what is the outlook for the tech industry since the potential recovery from the pandemic may decrease the boost of the cloud-based solutions? I'm particularly interested in fintech. I think, well, as we've seen over, because of the increasing representation of tech in the broad indices, especially like the S&P 500, 35 to 40% of the market in the S&P 500 is now represented by tech. So when those companies move, we get positive returns, and not all sectors in the S&P 500 had good years. So it's important to understand the tech as a driver. I think that technology is going to continue to define markets on a broad-based sort of thematic equity investment perspective. We're going to continue to see tech define what new markets are. And I would only point 10, 15 years ago when Amazon came out, was losing money, and it was losing money for 10 consecutive years. And there were a lot of naysayers about Amazon. And they kept borrowing money, they kept raising money, and people were saying, hey, they don't know how to make money. Yet in the end, what did they do? What they did was they defined the market for e-commerce and built the infrastructure to do that. And now AWS is its largest profitability, and they're one of the behemoths in this market. So when you look at tech and fintech in particular, we see what tech is doing is increasing productivity, especially in the service areas. I think we're still fairly early in the adoption phase of cloud computing. If you look at, there's sort of an S curve, and I don't have the slide with me today, but I can show it to anybody who's concerned. There's an adoption curve of this kind of technology, and for certain areas of the technology, like cloud computing, like genomics, like even electric vehicles and things like that, we're still early in the adoption curve. Whereas by contrast, if we look at the internet or internet usage, we're fairly late in the adoption curve. Most people have used the internet, and most people use the internet for many, many, many things now. So the adoption of using the web is very late in the adoption curve, but there's still many areas that are early. And these are new markets that are getting defined every day, whether it be electric storage and using batteries, whether it be recycling or clean energy or clean tech. I think technology is still going to lead the way for many years to come. That's from my vantage point right now. We have a lot riding on vaccine rollout. Are the numbers being watched in reference to both vaccine effectiveness and more vaccine coming online? So far, it's been disappointing, the vaccine rollout. Admittedly, I think everybody understands that, and more so in places like Europe, for instance, where you have strong national health systems, but they just have bungled their rollout. United States has been accused of bungling its lockdowns, but our rollout is only second, and the vaccines is only second to the UK. So I think in terms of the vaccination, so there's two factors here that should help us get beyond the pandemic. One is the number of people who have already been infected and obviously haven't died from it. Not to belittle that, a lot of people have, but people get immunization through either a real infection or through vaccination. And as those numbers combine, the combined percentage of the population starts to reach 60 to 70%. And we, be honest, we don't really know what the true number is because we don't really know how many people actually have been infected. But what you're going to see is that number gets bigger. You're going to see cases, hospitalizations, and you're going to see deaths declining as you're seeing right now. And we're still in our winter months, but we're already seeing that. Some people attribute that to lockdowns and habit, but some of that has to be attributable to how many people have developed some immunity already. And I think we're going to see that just increase going forward. And I think what I've read is that we might see another uptick maybe next fall, possibly. We're going to see a downtick in the summer months, which is normal for influenza-like viruses like this. We could see another one, but it's doubtful that the next wave is going to be more. Even with the new variants, they don't seem to be more lethal, though they may spread faster. So I think we're definitely, by 2022, the prediction about the Roaring 20s is going to come about. Next question, you mentioned geopolitical risk. How does the risk level now compare to where we were in 2010? How serious should be considered geopolitical risk today? That's a very good question. And obviously the biggest geopolitical risk is potential conflict, because war is the ultimate destruction of real capital. It destroys buildings, it destroys capital invested, and it's the worst thing that could possibly happen. I think the risks are low of some major conflagration. However, the other geopolitical risk is, you might say, the rise of populism, the rise of nationalism, which could affect the global economic system that's now in place. And I think you're going to see continued tension along those lines. So I think that's also a risk that could be a headwind to economic growth. It's hard to predict, though, and these things take a long time, just as globalization took a long time to feel its effects on modern economies like Europe and the United States. It equally will take a longer time to affect as we reverse these potentially with populist nationalist movements. So I think there's a headwind there because it takes time for companies and their CapEx, their capital investments, to react to these kind of changes. And arguably there might be winners in this process versus losers, though it's hard to see how a diminished global market could be good for any company anywhere. So I think there's potentially more. There's still risk. I think it's lowered because I think that the United States under the new administration will be more prone to hammering out deals and will be less quixotic and volatile. I mean, that was the problem in the previous administration, was really businesses just didn't know where they were going to be in a month's time because it was so quixotic and things could change on a dime. So I think that's, the positive here in the geopolitical environment is that we probably have, more level heads dealing with these negotiations, even though I think some of the tensions, like with China and their practices, their intellectual property practices, and their state subsidy practices are still going to be an issue for many administrations to come. That's my viewpoint. I just feel like I don't think it's going to be a major issue for sort of earnings outlooks, at least right now, unless something more major happens. So far, great questions. Do we have any more? Don't be shy. There's no dumb question. There's no silly question. I want to answer everybody's questions. For most of you, you're going to be getting an email in the near future with a bookings feature to book your annual review with us. January and February, the first quarter is when we generally start reaching out. So you can also ask questions at that time during our annual review. If you have questions about your risk profile, or if you're sleeping uneasy these days, we want to know about it because we all want you to sleep well. So if you don't have any other questions, I will proceed to wrap this State of the Markets address up. Thank you for all attending, and they will be a recording following that we'll send out. Thank you for all for attending. Take care.